Welcome, everyone. This is Kyle, Cain, and Peter Culver from Freedom Family Office, and we're here with another edition of Rich Beyond Money, your guide to personal and financial freedom. Today, we're going to talk about one of our favorite topics, taxes, but specifically taxes on your investments, how to defer them, avoid them, and actually eliminate them completely. Kyle, why don't we set the stage for our audience today and just review briefly what are all the types of taxes that a person who owns investment might face? There's quite a few. And so want to kind of make sure we're following the moving ball there before we get into how to get rid of them.
Yeah. So there's, I guess best way to describe it is sort of two categories on taxation of capital assets. There's the buying and selling, the capital gains and losses, and then there's the income aspect. And, the income aspect, same as on the capital gain side or sales side, is there's two different qualifications, right? Certain dividends, interest, et cetera. Dividends can follow into two different categories: qualified dividends or non-qualified dividends. Qualified dividends is where you have a longer holding period. You hold the position for longer than 61 days, and it gets a preferential tax treatment. Anything else would be taxed at ordinary. And, same on the taxable side, income from corporate bonds, government bonds, et cetera. Those are fully taxable at your federal income tax rate. The only thing that can kind of avoid some of that taxation is interest now on the municipal market side. Once you start investing in the municipal space, the income from there is tax-free. Going back over to the gains, same thing. There's two sets of taxation. There's long-term capital gains, which is where you've held the position for longer than a year. That can also, again, get preferential tax treatment, and you can get a lower tax rate on it. And then anything held less than a year at a gain, we tax that ordinary income. And then, on top of all these, if you happen to be in a higher tax bracket, then you can also get hit with a 3.8% net, investment income taxation. So, top end, if you're in the top tax bracket, taxation could be as much as 40% on some of these investments. Hence why it's, important to try to figure out ways, if at all, to avoid some of that taxation. That being said, Peter, go ahead and, tell us a little bit of what, are often some of the things people do to help try to offset some of those gains.
So I think the first thing we want to talk about is trading profits. We had an interesting actual little case study this year. We had a client who's actually a very active trader. So he's buying and selling stocks short term. So as Kyle just said, that type of trading would be subject to ordinary income tax, maybe 50%, depending upon what state he lived in. And there's a technique that we use called harvesting losses to offset against the gain. I would say very well known to people in our industry, but interestingly enough, not that well known to the average person. And so this gentleman who was trading his own portfolio was doing it himself, was not working with an investment advisor. And he called to our attention the fact that, whoa, I have $900,000 of short-term trading profits, i.e. ordinary income. Is there anything I can do about that? So the short answer is, if in the same year that he's created those gains, he has losses, those can be offset dollar for dollar against the gains. And in this gentleman's case, he had, just because he was such an active trader, even though he did a great job creating the $900,000 in gains, he had more losses than gain. And so we showed him how simply by what we call affectionately harvesting the losses, just selling the positions with the losses in that calendar tax year, those can be offset against the gains, effectively nullifying them. So Kyle, maybe two questions, little follow-up questions on harvesting losses. First question is, when should you do that? Arguably, let's take my gentleman's case. He had to sell $900,000 worth of losers to offset against his gains. But that means in the short run, he's got $900,000 of cash. What are the rules around reinvesting back into the market? He doesn't want to be out of the market for a long time. So guide us through those two little subcategories of the harvesting loss technique?
Certainly, yeah. What we've found is that even the individuals who have heard of tax loss harvesting and sort of made it a practice, really common that they wait to the end of the year, they kind of say, hey, do I have any losses? And then they try to realize it then. Well, as we know, and we've seen here at the beginning of this year in 2022, volatility can happen at any time throughout the year. We think it's always important to be diligent to take advantage of no one wants the market to be down throughout a year, but take advantage when those, opportunities present themselves to harvest those losses throughout the year. The question then goes back to what you said is, okay, so you have a position that dropped and you sell it to realize that loss, now you're out of that position. And what if the markets rebound and you're not getting that exposure? The way the rules work is that you can't turn around and buy back that same security within a 31-day period to still qualify for the loss. If you bought it back before then, it becomes what we call a wash sale and the loss is disallowed. So ways to get around that wash sale rule is that you can buy securities similar. Can't buy the same security, but you can buy similar. So oftentimes, let's say it was a stock in a tech industry, you can sell that as a loss and then immediately buy back, let's say, a tech index or an alternative or a competitor, so that you can still get the overall exposure to what you want, but realize that tax loss.
That's one little area in which we can avoid capital gains taxes that are driven by trading activity. Another common way to reduce or eliminate taxes with investments relates to where we buy investments or where we buy certain types of investments. In our world, that's what we call asset location. So I've decided I want to own Netflix. Where should I own Netflix? So Kyle, walk us through a little bit some of the options in the asset location area to help us reduce our tax bill.
A lot of individuals have heard of asset allocation. What we're referring to is asset location, as you said. And it's, there's different types of accounts that have different types of taxation, right? If you have your 401k through work or an IRA, that's what we consider a tax deferred vehicle. You're not paying taxes and you're getting a potential deduction on those contributions. But year in, year out, while that money's in there, there is no taxation, no matter how much you buy, sell, dividends, and interest. Another example, different type of account type, a Roth IRA, a Roth 401k. Difference there is, again, now you don't get the deduction up front, but everything that happens in it, you're not getting taxed on year to year, and it's tax free when it eventually comes out. And then the last type of, account structure is just a regular taxable account where every single transaction that you do is taxable in that given tax year. So the concept around asset location is the fact that different investments have different tax, criteria, like we said before, tax implications. So what you want to try to do is structure your portfolio, especially if you follow an asset allocation strategy, this is really important, is follow a structure where you can try to be as tax efficient as possible. So example, those things like taxable bonds, where it's ordinary income, REITs, which are usually ordinary income, mutual funds that have high turnover, things like that. We would say you want to try to hide those as much as possible in those 401k, those tax deferred IRAs, et cetera. Areas where a Roth IRA can benefit is since they have that tax-free notion of it in the long term, you want to go ahead and try to anything that you have the highest growth potential, that long-term capital appreciation is, best to try to fit into that Roth IRA. And then the other portions that are a little more tax efficient, ETFs, potentially, individual stocks, things like that you can try to be as tax efficient as possible. Those are what you want more in those taxable accounts. So again, overall, you still, want to follow that asset allocation strategy, but if you can follow a good location on where, it can certainly help with that compounding growth and avoidance of taxation in the long term. So Peter, those are some ideas around where to put the assets, how to try to offset some gains from losses. What are some other strategies that individuals do to try to help with saving on taxation?
So I think one big area here is in the charitable arena, and gifts to charity offer some opportunities to save on taxes. So let's just take a very basic situation. I want to make a $10,000 contribution to my favorite charity. Let's assume for the sake of argument that I had cash in my bank account. I could just write a check to charity, or I had a stock that I owned with a big capital gain. If I just write the check to charity, great. The charity gets the $10,000. I get a tax deduction, but I still own my asset with the big capital gain. Assuming I'm willing to forego owning that amount of the stock in question, I could give the stock to charity. I get the same deduction, but the built-in capital gain goes away. In a way, this is somewhat similar to the conversation we had about harvesting losses. This is something you want to think about kind of throughout the year. A lot of people make their charitable contributions, let's say in the fourth quarter. And a good tactic to follow is before you just start writing checks, is look at your portfolio and see if it might not make sense to lighten up on some positions. And especially if they're positions with large capital gains, you can give those appreciated stocks to charity. You get the full deduction based on the current value of the stock, but in effect, what that does is make the capital gain go away. So if we carry that a little bit further, the consequence of just giving the stock to charity is, okay, I got a charitable deduction, but the charity's got my stock. So I've fully given up all the attributes of that particular asset. Another strategy that people sometimes do is rather than giving the stock to a charity, they give the same stock to a trust called a charitable remainder trust. And essentially the way that works is I give the stock to the charitable remainder trust. Because it's considered a nonprofit organization, I get the same tax deduction as I would have gotten if I gave it to the United Way. But what happens is for a period of years or for the rest of my life, that trust pays me income, usually in the range of 5 or 6%. And then when I pass away, the stock goes to the charity. So it's a way of getting a deduction, but continuing to receive some benefit while I'm still alive. Some technical rules behind that, but something interesting to think about. Now, a third kind of charitable giving strategy is really sort of the inverse of the charitable remainder trust, which is called a charitable lead trust, which is you put an asset in a trust, and while you're alive, usually for a period of years, the trust gives the income to the charity. And typically you would be giving away an amount of income that's less than the appreciation. And what that means is at the end of the lifetime of that trust, usually 20 years, all the principal comes back to your family. So that's a way to make current charitable contributions, but not have all the money disappear forever and provide a way for it to come back. So some nuances, obviously, to each one of those, but thinking about charity and gifts to charity as a way to deal with appreciation is an important area. Kyle, another thing that comes up a lot, getting a lot of attention right now, are so-called IRA conversions into a Roth IRA. And maybe just describe what's going on there, how that might work, and how it could benefit someone in the long run in saving taxes.
This is definitely a good strategy that we think makes sense with some longer term financial planning. Right. The concept here is that, as we discussed before, a Roth IRA, long-term tax-free growth. It doesn't really get much better than anything being tax-free. So, how do you get your money into a Roth in the first place? And there's certain rules on, how much money you can contribute each year, et cetera. A lot of investors will do is what's called a Roth conversion. You convert some of that 401k or that traditional IRA, and you're able to move it over into a Roth. The implications there is though that money is taxable as you pull it out from the 401k or the IRA into the Roth. So why would someone want to create taxation right now? Again, it's that point that now those assets are in that Roth IRA, and any appreciation long-term is tax-free. So what we see is sometimes when there's a big pullback in the stock market or something like that, and there's, particular securities that someone wants to own, let's say they own a certain amount of a particular stock and now it's dropped, they can convert those shares over to a Roth IRA at that depressed value. And then assuming that the thesis is that stock is going to come back, now all that future appreciation becomes tax-free. Another way, obviously, as far as planning is if you can find out certain years you have more write-offs or you can be in a lower potential tax bracket now versus the future, then it can make sense to expedite and do those Roth conversions now. So it's definitely a good longer term tax strategy if you can incorporate it into your financial planning.
I mean, I guess the reason the long term relates to the fact that, let's say I pull $100,000 out of a Roth, make up a number, I'm in a 30% tax bracket, I'm going to have to pay a tax of 30% on the 100 that I pulled out because it's considered a distribution. Over a longer period of time, the growth of the money still in the now Roth IRA should recoup that, but it's not instantaneous, right? And we do for many, many clients financial planning calculations to help them estimate what that recoupment period is and in light of their overall circumstance, whether that makes sense to them.
Exactly. There's other strategies that we can, help individuals with, and some of them more complex than others. But Peter, share a couple other ideas.
Sure. So another strategy that we do use with a number of clients is really very akin to the Roth IRA. It's called a private placement life insurance policy. Simplistically, what you do is it's another form really of asset location. So imagine I have a $5 million investment portfolio. It's in my own name, or it's in a trust I've set up. All those taxes that we talked about at the beginning are potentially applicable to that investment. There is a way to reposition or start the portfolio, more ideally start the portfolio inside a structure of a life insurance policy. And if you do that, you have basically created the equivalent of a Roth IRA. And the reason is that under the tax code, life insurance, the growth of assets inside a life insurance policy are tax deferred. There are no taxes on trading profits, income, dividends, interest, all of that. Similarly, when you take money out of a private placement life insurance policy, the money that you take out is not taxed. And so this can be, in one sense, it's immediately beneficial because you've eliminated the taxes. But when you run the numbers and compare how much a $5 million portfolio would grow if it paid normal taxes and how much it would pay if it didn't pay any taxes, very similar to Roth IRA, the numbers are quite phenomenal. And so private placement life insurance is an excellent structure to position assets for the long term. They're very often used in trust for children, trust for grandchildren, definitely some nuances kind of under the hood there. So if that's appealing to you, contact us. And then I think one other one we wanted to mention, which is popular now, is what's called an opportunity zone investment. 3, 4, 5 years ago, Congress passed a law to encourage investment in what are known as opportunity zones, which are places that are underserved and we're trying to create more opportunity. And simplistically, the way this works is if you have a large capital gain and within 180 days of the date of the gain, you contribute the gain to an opportunity zone investment, two things happen. One, you completely defer the tax on the gain for 7 years. So that can be quite attractive to individuals. If at the end of the 7 years, you decide to stay in the investment that you made for another 3 years, whatever gain there was on the amount of money that you put into the opportunity zone, that ultimate gain, there is no tax whatsoever. So another strategy where time is your friend in one sense, or your enemy if you need the money, but it's a terrific strategy to defer particularly a very large gain. So Kyle, I think those were not every strategy, under the sun to reduce taxes, but I think the point is there's some quite significant taxes on investments ranging from 15 to 20% up to potentially whatever ordinary income tax bracket you're in. And there are actually quite a lot of strategies to lower, defer, eliminate tax. Kyle, thanks for joining me again today, and thanks for everyone for listening.